Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, April 19, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. All in all, it was a pretty interesting day out here in the market today. At the close, it doesn't look like much happened. The broker-dealer index was basically flat. The transports were up 0.5%. The S&P 500 cash index was down 4 points. The Dow was down 118 or 19 points, mainly on the back of IBM, which accounts for a big portion of the Dow. So IBM was down about, I think, $8 today, and therefore, I think that accounts for about 50 points in the Dow, something like that. And so the NASDAQ ended up finishing up 13 points. So all in all, really wasn't a big deal out here today, but there is something that I want to show you, and there's a couple of things that we need to discuss. So when you look at the intraday 10-minute chart, you can see here we had a gap higher, and then we had a steady diet of selling all day long. This is a gap and crap. Now, all in all, it doesn't really mean that much because A, it's options expiration week, and it's also Wednesday, and this is notoriously known as Whipsaw Wednesday. Listen, the option guys, I should say guys and girls, the option people on the options desk at the big institutional trading firms, whether they're hedge funds, whether they're the big institutional money center banks, all of the above. These people will take the market and individual stocks in one direction or another in an effort to make certain option strike prices or options based on certain strike prices expire worthless. So we have to take some of today's steady diet of selling with a grain of salt after the gap higher. That could easily have been manipulated by the institutional traders, and yes, they can do that. They have enough money sloshing around in the markets where they can pretty much do whatever they want. When you look at the spiders, we're going to finish the day around 65 million shares. That's not a big trading day one way or the other. So we didn't have institutional participation on the sell side today. And if we did, things may be just slightly different. So when I go back to the daily chart, all right, and I look at the pattern, it's certainly not a pattern of strength. So we need to note that. So this is a bearish pattern and we're below the moving averages. So certainly the market is susceptible to lower prices. I've adjusted the lines on the chart a little bit. I took that line off at 232.30 whatever, and I left the, or actually I moved it to 231.61, which is the low pivot from the 27th of March. And the reason I did that is because that's going to be a line in the sand. A close below that low, and we're first going to visit 230, and then we could potentially visit 228. Nothing's changed from what we've been talking about. I'm just reiterating, but this is certainly not a pattern of strength. As long as we maintain below, the market maintains below the moving averages here, we are making a bearish pattern and we are susceptible to another down move. That is certainly in the cards if we can't get up off the mat and catch a bid. We did have some poor market reaction from some big stalwarts out there in the market. Goldman Sachs was down hard after earnings. IBM down hard after earnings. Hard for IBM. It's not a huge mover, but down 5% is a pretty big move for IBM. So what we're seeing is some of the euphoria has left the market. However, we're just now getting into the heart of earnings season. We're in options expiration week, so anything goes. There can be a spark on the upside or the downside at any point in time. We're still looking for a low. As far as I'm concerned, the low is a little bit past the time frame when I thought the low would be in. So that in and of itself has been wrong, but we're still looking for a low one way or the other. If that low comes in a week or two later than I thought it would and slightly lower price than I thought it would, so be it. We've had these prices on the charts for quite some time. We just don't know exactly where and when that low is going to come in, and that's what makes a market. You know, the market is always going to trade to somebody's number. Sometimes it trades to my numbers, and sometimes it doesn't. But what we do is we try and put together all the pieces to the puzzle, all the evidence, and come up with the most likely scenario going forward with no preconceived notion. We want to leave our bias at the door. And if I look at the chart, I'm telling you this chart looks bearish. I know from a cyclical perspective, we should be making a low. The market should be turning up, and it may have to be after options expiration, after this week. That's another possibility. Maybe we find a low on Friday or Monday, and then finally, we'll get a turn, and then some of the buyers will step back into the market. But right now, the market's been somewhat lackluster, and we just have to take the market that's in front of us. You take what the market gives you. Now, here's another way we know that there really wasn't institutional participation on the sell side today. Why? Because the IWM was up today. It was up 60 cents, not tremendous, but it was up nonetheless, almost 0.5%. And what happened? We got above the 20-period moving average, which is the red trend line. We traded into the 50 and backed off, finished near the lows, but guess what? I'll take that. We closed above the 20, which is a positive sign in the IWM. We take it one step at a time. Obviously, we're still in a longer-term bearish pattern that we need to break out of. It's a down move, and this is basically a bearish wedge pattern that generally sets up for another down move. However, from a cyclical perspective, I'm just suspect that we're going to get that full and complete down move at this point in time, but of course, anything goes. The market's just a little bit difficult to read right now, and that's part of the market's allure. The allure is that or not the allure, but the market is designed to fool and trick as many people as possible, as much of the time as possible, and that's part and parcel to what happens during options expiration week. The market goes back and forth. Somebody looks at the end of the day that's not watching the market all day long, and they look and they say, oh, the Dow was down 100 points, or the S&P was down 4 points. No big deal, nothing happened. Or the Dow was up 50 points or down 50 points, and they don't really think about the activity during the day. That's my job. I look at the activity in all the markets all day long and try and decipher what the next larger move is going to be. And what I will tell you from a larger move perspective, regardless of whether we go down farther first or not, there's a bigger move brewing, and this is generally what happens. The market plays some tricks. It goes back and forth. It has what I like to call unusual behavior. Right now, the market has had, for the last several days, unusual behavior, both intraday and from one day to the next. It hasn't been exactly normal. The market's not ever really just absolute normal, but it has been a little more unusual than normally. So therefore, when I see that, it's generally setting up for a larger directional move, and I still contend that ultimately that larger directional move will be on the upside. We will make new highs, and it will come within the next couple of months. And if I'm proven wrong, so be it, but I haven't changed that tune just yet. Another leading indicator that I like to use, as you know, is the transports. And the transports were up today 0.5%. No big deal one way or the other. You can make a case this is a bearish pattern being contained by the 20-period moving average that was basically rejected, or the transports were rejected at the 20-period moving average today and finished down near the lows with the rest of the markets. So as bearish patterns go, this is certainly setting up sideways, building energy to go lower unless we can catch a bid, leap over the 20-period moving average, and get something going on the upside. Until and unless that happens, the transports have lower prices coming if this bearish pattern, like the other markets, does play out. We'll take a look at the VIX tonight again, since we looked at it last night, and you'll see here that we did see an up day in the VIX after two pretty good down days, a reversal day, another down day yesterday, and then today we had an up day, but it wasn't up all that much. It was up 3%, so that's not that big of a deal. And considering the market was down the majority of the day after making highs in the morning, I don't know if we can read all that much into the VIX behavior today. Just wanted to show you the picture, but I can't really make any kind of determination one way or the other from today's activity, so we'll just leave it alone. I do want to look at the strong horse, though, and the NASDAQ remains the strong horse. And you can see here, we took a run to get over the 20-period moving average and failed like the other markets, but the NASDAQ, this is the NASDAQ 100, which is obviously a top-heavy weighted index with the big names, the Apples, the Googles, the Amazons, the Netflix. And so that's the reason, as you know, why I don't like to use it as a leading indicator. However, it's still the strong horse. From a technical perspective, there's really nothing wrong with this market. Even if we come down lower and another 50 or even 100 points on the NASDAQ, it's not going to do much damage to the bigger picture. When you look at the weekly chart, okay, we could come down to 5,208, the 20-period moving average on a weekly chart, and still be in a solid uptrend in the NASDAQ. That's almost 200 points from where we are now. So there's really nothing technically wrong with the NASDAQ market. And until and unless the NASDAQ starts to crack, then these markets are just gyrating around and eventually will find a low and take off to the upside, as I suspect it will, but it just may take a little more time. All right, heading over to the gold market, we saw a nice sell-off in gold today, down $13. Let me get some of this stuff off the chart that you don't need to see. That was for intraday stuff. And basically, we came in, and look what we retested today. On low was 1275.40, and my number was 1274.9. That was that old resistance point that we kept on the chart. So these numbers have a tendency to repeat over and over again. We'll see if today's activity, this is a reversal candle, but we'll see how meaningful it is. We could just be going back and forth, putting in a bullish pattern, setting up for higher prices. If we get a further sell-off in the stock market, I suspect we'll see a spike higher in gold. So I'm just kind of holding in a holding pattern on making a determination for gold. I'm not going to read too much into a 1% down day in the price of gold. We could easily reverse that tomorrow. There's nothing really here that changes yesterday's discussion at all. It's really just making a bullish pattern going back and forth in this upper range. So the longer we do that, back and forth in this upper range above the moving averages, the more likelihood gold will have to continue pushing higher to some of the higher numbers that we have on the charts. So we're going to reserve any kind of a short-term call on gold to see a little more evidence. To me, all it's doing is making bullish consolidation. A $13 down day on a $1,280 equity or instrument isn't really anything to worry about. Looking over at silver, came into the 20-period moving average, 3 days down in a row, but we're still in this upper range. We're still really in this bullish consolidation phase. So again, I'm not going to read anything short-term into today's activity in gold or silver. I'm just going to suggest that while we're in this position above the moving averages in the upper range that we've been consolidating in, that it's still consolidating to build energy to go higher. That's what I see in the metals, and that could be ominous for the stock market in the short term. I know some folks like to trade GDX. We'll bring that up. I do that from time to time. And as you can see, we talked about the 200 being resistance. Wasn't going to get through this area without a fight. Didn't even put up a fight at all. It just got immediately rejected. And as you can see, today was a pretty hefty down day in the GDX, down 3.5% or so into the moving averages, back into this, what you can see is prior consolidation. So this was the last place the market broke out, and this is the place where the market came back to retest, which happened to be coinciding, coinciding with where the moving averages are. So we'll have to see. A lot depends on, with GDX, depends on two things. A, it depends on the stock market because GDX is made up of stocks that are gold mining stocks. Now, if the stock market takes a hit, those stocks, like any others, are susceptible to go down with the overall market. On the flip side, they're also tied to the price of gold. So if gold is rising and the stock market is selling, which way does GDX go? It's a tough question to answer because it goes in both directions. I've seen both. Sometimes it will rise with the metal even in a declining stock market and vice versa. Either way, right now there's nothing to do with GDX. There's no bullish pattern here. It's more bearish than bullish. We're into the moving average. We're into the moving averages, and therefore we just need more evidence, and we'll move it along and take a look at crude oil, which absolutely got hammered today. We talked about this number yesterday. We talked about 51. I didn't think it was coming 24 hours later, but the 51 came. We were down 3.5%, almost $2 in the price of crude oil. That's a pretty big down day. It was on decent volume, but I'm not sure this was an exhaustion move, meaning the final move down. I think there's more downside coming in the price of crude. It just makes sense that crude will revisit $50. It just seems obvious to me. At that point, I will be looking for signs of a reversal. We don't have anything like that today, so there's nothing to do. Just watching it day by day, looking for a signal that there's a potential trade in front of us. Right now, just let it fall. It's probably got farther to go down to the $50 level. The bond market. Today, the bond market got as high as 155.16. Pardon me, 10. Yesterday was 16 against the target that I had on here of 155.20. And we pulled off. So that is providing a level of resistance. We didn't quite get to the number, but we came very, very close. And today we had just a pullback day. But again, this is just a pullback in an uptrend. We could certainly have higher prices coming in the bond market, specifically if the stock market comes under some selling pressure. So I wouldn't look at this as a top in the bond market. I think it was just a little bit of a pullback in the midst of an uptrend. If we consolidate here for a while, then this number moves up and we'll go right up into the 200-period moving average if we consolidate here for 3 or 4 more days, something like that. That is possible, but if we have any kind of a sell-off in the stock market, my expectation is that the bond market will rise again, whether it's tomorrow or Friday or whenever that comes. So still an uptrend in bonds. And, we talked about, a long time ago, we talked about 159, 160 in the bond market. Whether or not we actually get up to that price, certainly I don't expect that on this move. But we talked about it a couple of 3 months ago, and we talked about it being in the time frame of likely the second half of the year. Now, maybe that's still possible, but it certainly has come a little bit earlier than I would have anticipated. But nevertheless, that rally was coming one way or the other. And in the dollar, when you look at the dollar, it was just a little bit of an uptick after yesterday's down day. Can't read anything into it. We're right smack in the middle of this downward channel. My contention is we go towards the lower end of the channel. However, it's going to take some time. Nothing to do until and unless we get there, or until and unless we get above the top end of this channel. Other than that, we're going to stay in this channel and banter back and forth. And while we do that, unless we see a tradable pattern, there's nothing to do in the dollar. Should have more selling pressure coming in the near term or in the future in the dollar. And with that, I'm going to wrap it here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.